can remain irrational longer than you can remain solvent. On that
Perfect.
thought, welcome to our Zoom web series hosted by One Tree Hill and PMS Cart. This is on the Juggernauts, conversations with uncommon and curious fund managers. Hi everyone, my name is Jai and I have with me today Nalin Moniz. Nalin is currently the CIO at Alternate Equity at Edelweiss Global Management and is also considered the father of AIF trading in India. Welcome Nalin to our show.
Thanks for having me on, Jay.
Most welcome. If you don't mind, what we like to get into immediately to get sort of the creative juices flowing and adrenaline pumping is what we call the machine gun 15, right?
Okay.
These questions hopefully will put you and make you think about a few things, and should be fun for both of us, right?
Okay.
If you're ready, I can.
Is there a hamper at the end, like coffee with Karan?
You'll see.
Okay.
Right. So if you're ready, we'll get started.
Let's do it.
Perfect. Okay. So first thing first, the most important question in everybody's mind: are we at the bottom?
I don't think so. There is more pain to come, and that's what we see in the economy, and we're talking to companies.
Okay. Will oil go back to zero in any future contract?
It depends on the storage. Certainly if the US storage in Cushing, Oklahoma remains full, then we could see negative oil prices or similar anomalies.
Okay. Which balance sheet seems to be the most stretched? The government, the corporate, or the individual?
I think the individual is perhaps the most resilient because typically Indian households have been very under-levered.
Okay. Top down or bottom up?
Definitely bottom up at this stage.
Okay. So then sort of extension to that question, do you diversify in equities or do you concentrate in equities?
No, I think this is the time to diversify because there will be accidents and you don't know ahead of time where there may be accidents. So it's important to diversify.
Okay, fair enough. Would you double down or double up?
I would remain where I am today. I would do neither.
Okay, fair enough. One aspect that most people don't know about you.
This is my first time growing a beard.
Okay, fair enough. Doesn't look all that bad, Nalin.
No, this is the result of 1 month of hard work. Complaints from my wife.
Excellent. As a person, do you consider yourself an optimist, pessimist, or a realist?
I am a realist. I think any long short fund manager has to be a realist.
Sure. And on that note, how would you consider a research on the street from a scale of 1 to 10, 1 being poor, 10 being great?
Oh, this is PMS card?
For anyone, including PMS card.
No, I think that you guys are doing a fantastic job. And in fact, when I speak about the AIF and PMS industry, I talk about people like you and other aggregators as being, the biggest catalyst for growth in the industry. So great job.
Sure. Thanks, Nalin. How long do you think India will remain an emerging market?
So I think if you look at it, we are already the 5th largest economy in the world. We are already a developed market by that sense. We are just classified as an emerging market by MSCI and other global index providers.
Okay, fair enough. What is the one thing, you've obviously come with a ton of experience across various products, across various asset classes. What is the one thing that people across decades continue to get wrong, or to put it another way, that have a misconception about the markets?
I think the one thing that people certainly get wrong, Jay, is that when things are going in their favor, typically when prices are going up, they don't ask enough tough questions about the fund manager, about the advisor, and about the stocks that they may have in a portfolio. And by the way, this applies to what is happening on the debt side as well today.
Sure. No, that's exactly my next question. With the fund houses doing what they are on the debt side, do you think that will snowball into something bigger, or it's a one-time event
Right. So, Jay, I think we will see far-reaching changes on the debt fund side. I think first is a lot of credit activity that was happening on the debt mutual fund side will
Sure.
perhaps, will perhaps move to an AIF or an NBFC format,
Okay.
where there isn't daily liquidity and then hence a ALM mismatch.
Sure.
And I think people are going to ask a lot tougher questions. There may be provisioning on debt funds. There may be liquidity reserves that debt funds have to reserve. So
Right.
there will be far sweeping regulatory changes. And as of today, I think the industry does need to rebuild some of the trust that has been lost from investors and advisors.
Sure, absolutely. Completely agree out there, Nalin. And with sort of COVID taking over our lives in a manner which no one thought, it also opens up the question that will ESG investing sort of catch on in India, or will there be more focus on ESG investing?
Absolutely. I think this is one of the big trends that we see emerging in the next 10 years. Um, you know, the G of ESG, which is governance, I think, has always been important and been acknowledged by the public markets.
Right.
Uh, but the environmental and social aspects are starting to be taken a lot more seriously. You're already seeing that with um, SEBI introducing a stewardship code for AIFs and mutual funds.
Sure.
A lot of global investors insisting that you have an ESG policy in place. Um, and this episode of COVID has also been a wake-up call for the conscience of many promoters who are otherwise taking shortcuts on ESG.
Got it. Got it. Fair enough. So that's definitely something to watch out for, according to you.
Absolutely. It's a big, big trend.
Okay, perfect. And Nalin, you obviously run one of India's largest long short funds. One of the sort of the key question that comes up is that okay, as you also mentioned, governance, corporate governance, etc. But what is the other sort of red flag that you would look for in a stock outside of corporate governance?
So I think the one thing that the market has definitely punished very badly is high leverage and high pledged shares. Uh,
Sure.
and typically the modus operandi for a lot of businesses in India was to, you know, have less equity in the business and have more debt, uh, and then over invoice or try and cheat the banking system of their fair share. Uh,
Okay.
that playbook has completely been thrown out of the window over the last 2 years. And what a lot of businesses need today is a lot more equity and less debt.
Sure. Fair enough. Great, Nalin. I think you've come up with flying colors. I
Okay.
requested that your hamper of coffee with current should be there at your place as soon as the
Okay.
lockdown ends.
Cool.
I can't make any guarantees of when the lockdown ends. But you're talking about the lockdown. Where do you see the lockdown, especially in a city like Bombay, which is quite core to the Indian economy of sorts? Where do you think the lockdown is going?
Okay, so I think Jay, we still have cases rising, and I think perhaps it will be a phased opening, and we'll probably revert to normal times by maybe September. Uh, or at least that's what I'm mentally preparing to return. I'd love to get back to normal sooner, but I think September is a realistic target, unless of course a vaccine or a cure is found for COVID.
Sure. So, this came up in one of the other conversations. So more like the Nike logo, right, where there's sort of a strict lockdown and then sort of eases up into opening.
Yep.
Oh,
Yes.
perfect. One of the things that a lot of people want to know about fund managers when there's very actual little information available, except for what the marketing material that is put up. What was your first interaction with the stock market, right? Was it by chance? Like I was an engineer who came out of, electronics and, just randomly chanced upon Edelweiss to work upon. And that's how my journey started. What's your story with the stock market? Was it like a well thought out, sort of conscious call, or, just by chance?
No, so I had a very similar journey to yours, Jay. I studied computer science, finance, and statistics in college, and I thought the stock market was a fantastic place to apply all three of these disciplines because it has an element of data science, an element of finance and economics, and an element of the behavioral side that makes it so interesting. It's like the world's largest unsolved engineering problem.
Sure. Excellent. And, sort of talking about this issue, the fund that you run has done quite well relatively to its peers and the benchmark in the last few years. Sort of if you could elaborate what has been your sort of edge and USP and the processes that you followed to make it successful.
I think that we haven't done anything, extraordinary, Jay. I think there are two things that have helped us to really stand out. One is, uh, as you know, we have consistently bet on being long, good quality, high governance, strong cash flow companies, and short, broken businesses that are trading at expensive valuations. Uh, Now, this may not work in a year like 2017, where you have a junk fueled liquidity rally. But in the last 2 to 3 years, this has been the mega trend where there has been a flight to transparency, a flight to quality, a flight to governance. So I think this is one. I think the environment has favored our investment style. And I think the second thing that has helped us to stand out over the last 6 years that we've been running the fund is that, unlike a lot of short managers that are more traders, uh, we are much more of an investor. And even for our short positions, we're applying the same kind of rigorous fundamental research that you would apply to the longs. So investing over trading, and then basically quality minus junk has been our two big success factors.
Excellent. And, sort of taking an extension from this, a lot of our clients, a lot of the investors ask that, Jay, while a strategy might have done well or a process that might have done well, is there a lifespan to each process or each strategy? Or do you have to keep iterating, adjusting, sort of, in a market like this, questioning what you're doing and why you're doing it in terms of the process?
So we haven't made changes, Jay, and I think the important thing that applies to not just us but to other managers as well is that the simpler the investment process, the more uh, relies on a few basic fundamental assumptions or axioms, uh, the more resilient and robust it is to changing market conditions.
Sure. So the sort of, and I'm just going to give you sort of a curveball out here. Uh, this sort of lends itself to sort of getting married to a strategy or a particular investment, right? Now, as you said that, over time, as you simplify things, have your processes in place, you might see a good amount of volatility, right? But sometimes what does happen is an investor gets obviously saying that, look, why is he, clearly the market is not recognizing what you are seeing, right? But how does that play up in your mind, and how do you at that point sort of, control your emotional quotient, which is telling you that, look, uh, my investors might be thinking a bit different than what I am.
Right. So I think it starts when you, by first acknowledging that nobody's investment strategy will work all the time. Okay.
Absolutely.
And that's why, as an advisor and as a client, you have to invest across fund managers and across styles. I highlighted in your a couple of minutes ago when you asked me right up front that in a year like 2017, which is a liquidity driven rally,
Sure.
we will not be able to perform.
Right.
Uh, you know, in a year where the market is up 50-60%, which will happen at some point, we will trail the benchmark. Those are the kind of years that your mid and small cap funds may shine through.
Sure.
So we attempt to solve all problems, and we understand the role that we play in a client's portfolio. And as long as you're clear about that and you communicate it, I think you're okay.
Absolutely. No, makes complete sense. And sort of, continuing on that thought, I think a lot more investors, a lot more clients are now saying that, look, how do we sort of get into uncorrelated strategies and ideas, either through long short funds or through cash management or diversifying into gold, distressed, solar, unlisted shares, etc. Because you've been doing a lot of the uncorrelated stuff that is there on the market, would love to hear your thoughts on, different ideas that you've tried, whether personally, professionally, or what would you suggest that an investor do right now?
Right. So this is the one big question, Jay, that clients have been asking in March and April in particular, and asking very, very vociferous way. The reason is that last month, in the month of March, you had the Nifty down, some 23%, the mid cap down 30%, and it was a completely broad-based correction across sectors, styles, industries, market cap, etc. And there was nowhere to hide. And with the exception of maybe one or two managers, pretty much everybody was down in line with the benchmark. So this has got people questioning the fact that, if I had 5-6 fund managers, do I really have 5-6 distinct fund managers, or do I have four or five of the same kind? So today there is a lot more interest in people's, in portfolios where strategies are uncorrelated, either because somebody's thought process is completely orthogonal. So maybe playing cyclicals or deep value,
Right.
where the construct of the portfolio is completely different, like a long short portfolio rather than long only.
Sure.
Where it is tapping into something that you're not getting in the public markets, like you mentioned, solar or infra or distressed or something of that sort. I don't have much experience on the unlisted side,
Sure.
but certainly clients are looking at these non-traditional avenues for returns.
Got it. And I think we've been seeing this shift much earlier than pre-COVID as well, is where a lot of money, at least with the more nuanced investor, who can put in that 50 lakhs or 1 crore into a PMS or an EIF, sort of, mutual funds are now in general looked at as, sort of closet index funds, or what we call index huggers. Now, while it might not apply to all mutual funds and it would be not fair to paint them with the same brush, but are we heading towards that?
So we certainly are, Jay. What we are seeing as a very strong trend is there are certain categories of mutual funds where, alpha has basically gone to zero. It could be things like, very simple debt funds, liquid funds,
Sure.
large cap equities. And in these spaces, these are ripe for disruption by passive, vehicles. So you've seen,
Sure.
The SBI Nifty index fund becoming India's largest equity mutual fund.
Absolutely.
You've seen the success of Edelweiss Bharat bond on the debt side.
Correct.
But there are other categories like, let's say, mid and small cap equities, or even credit funds, where fund manager expertise will always be important. And those are not going to get disrupted by passive.
Absolutely. Absolutely. The next question is one of my favorite questions. When I started my career way back in 2004, I think in the first 3 months I lost close to 6-7 months of my salary on a unknown levered commodity play that my broker said that this will make you money. Obviously, greed took over, and
Right.
that's my biggest learning, that if you don't understand something, don't dabble with it. Uh, in your career, what would you say has been that one defining mistake or learning that you'd like to talk about?
Right. So, I lost a lot of money in the 2008 financial crisis, uh, and not because of, an imprudent bet on any single stock, but I just had the wrong asset allocation. Uh, and this made me real, and I had allocated very heavily to equities, and in particular, small cap equities, international value stocks, etc. Basically high beta. And I realized two things. That one is that, you know, it is important to have a balanced asset allocation at all points in time. And secondly, if you're in financial services and your income is linked to the stock market, then your personal balance sheet should perhaps be managed a little more conservatively.
Sure. Sure. So you're saying if you are from the finance field, you are, as it is, high beta to the market, uh, just being in the field.
Exactly.
Got it. Fair enough. That's a very interesting point of view, Nalin. Sort of continuing with this, a lot of our audience has also asked us that, we like to understand something different that the fund manager has done, right? So what was that one opportunity that maybe was obvious to you, and you sort of bought into it, but not obvious to the market in general?
Right. So I think one of our, if we're going to talk about a specific
Sorry,
opportunity,
I'm going to ask you this because I can ask a lot of people this. One
sure.
long idea and one short idea, if possible.
Okay. So I'll give you one of each. So one interesting, idea that we had that expired a few years ago was the HDFC warrant. Okay. So
Sure.
this was issued by HDFC Limited in 2015 alongside very low interest, bonds. And, we remained invested for the 3-year tenure of the instrument. Okay. Uh, we bought it at about 140 rupees and ended up selling it at about 500 in 3 years.
Wow.
So about a 3x in 3 years. But one of the things that people didn't understand about this was that uh, everybody was using a Black-Scholes kind of model to price these.
Sure.
Um, but the reality is that for a company like HDFC, which has very, very stable earnings and a very stable earnings trajectory, a model like Black-Scholes does not apply because HDFC Limited behaves more similar to a bond. So this was one. On the short side, we have one of our biggest, winners was to be short a lot of levered companies, uh, you know, and to be short a lot of PSU banks, which many people even today don't acknowledge that are perhaps insolvent because of the bad loan.
Sure. Okay. Makes sense. One of the other aspects also that comes up with investments, and this is, making a lot more sense in terms of diversification, is international investing, right? Two advantages that I see. One, obviously, is the diversification that occurs because maybe you're getting a different asset class in terms of geography and multiple other aspects. The other is obviously for an Indian that becomes a natural hedge of sorts if you're going into some sort of a dollar investment. I know Edelweiss has come up with a fund recently, which sort of is a feeder fund. But what is your view in terms of clients wanting to do more and more of international investing?
Right. So Jay, you really hit upon it. Uh, I think everybody's, today international investing is in focus because those funds have done well in the last 1 year.
Sure,
Uh, but that's not the reason to really look at it.
absolutely.
A diversifier to your equity portfolio, and perhaps maybe 5 to 10% should certainly go into feeder funds. We have a collection, but other fund houses also have very credible offerings. I personally have been investing in international funds for the last 5 years. Uh, Clients also should look at some investment options that are available through LRS, which is the Liberalized Remittance Scheme. And this should be looked at as a hedge in case something ever goes wrong with India at a sovereign level.
Sure, sure. So when continuing with this, diversification is obviously one aspect that a lot of people are talking about now, and sort of true diversification. But a lot of people have asked us that, Jay, where is the alpha for the next 5, 10 years going to come from? And if you could elaborate on any asset that you like apart from equities per se, that would be really helpful to our audience.
So Jay, I think the biggest alpha is and this is a real story. I mean, the biggest alpha that somebody could uh, generate is by just keeping their portfolio simple, sticking to a plan, and
Sure.
just trusting a a balanced advisor. Uh, this is the single biggest. I think uh, we are all swayed by greed and fear and market cycles that happen in equities and debt, in real estate, gold, etc. Uh, but just having a sense of balance and having things simple will add many percentage points to your actual portfolio returns.
Got it. We're almost coming to the end of this conversation, Nalin. Just a couple more questions. The next question is related to sort of, giving the tools or the options of tools to a much more broader audience of fund managers to be able to, either hedge their positions, go short some positions. As of now, obviously, the tools are only available to a good degree or to a flexible degree in our AIFs. But do you see a stage when a mutual fund manager also wants to raise his hand and says that, look, I actually felt, the markets would not have done well. I wanted to hedge, or maybe even have some options for a particular stocks that I had, or even increase sort of cash management. Obviously, we know that's possible in an AIF, but should that option be extended to fund managers belonging to the mutual fund or even the PMS segment?
So Jay, managers on the mutual fund side already have that option. There are offerings, the Balanced Advantage Fund, uh, that vary their amount of equity exposure depending on whether they think markets are cheap or expensive or will go up or go down.
Sure.
Uh, and even long only equity managers have an ability to take a cash call. Uh, there are some fund houses that are very proactive about doing that. Others remain fully invested at all times. Uh,
Sure.
and on the PMS side, there are no such restrictions. So if a PMS manager wants, he can always sit in 100% cash at a point
Right.
in time.
Right. And would you say leverage should be allowed in mutual funds or PMSs, or stick to AIF for the next 5 years?
So I think maybe stick to AIF for the
Okay.
time being.
Sure.
Because leverage, remember, Jay, is a double-edged sword.
Absolutely.
You don't want to expose retail investors to that. And it is perhaps best done in a fund format rather than in a managed account format, which is PMS.
Fair enough. Nalin, sort of the last couple of last questions. We've seen some sort of in the last 5 years, some sort of an exodus of star fund managers leaving to set up their own sort of boutique firms and trying to sell their own brand per se. This sort of ties in with having too many options suddenly, because each star fund manager is a great sales guy, has a great story. How does actually someone buy into a particular fund manager or a style per se?
Right. So I think, uh, many of these are stalwarts of the industry, whether it is a Saurabh Mukherjee at Marcellus, or Sunil Singhania at Abacus,
Sure.
or Kenneth Andrade at Old Bridge. And maybe we'll see many more following in their footsteps. Uh, each of these guys has a very clear and distinct investment philosophy they've developed over a period of time. Uh, and I would think that today many investors who are investing with them know that what they're getting into. In the case of Saurabh Mukherjee, just to take an example, I mean, he's written 3 fantastic books
Sure.
that outline, a sort of a buy and hold philosophy in high quality businesses. And he's done very well implementing that.
Fair enough. So effectively, you're saying that just make sure that you understand their philosophy, making sure they're uncorrelated to things that you probably already have on your books, and then take that foot forward.
And understand when they will work and when they will not work.
Excellent, excellent. Nalin, you've been a great help, and we work together,
Yeah.
and sort of mentoring has helped a lot of people in various organizations. One of the questions that we get from a lot of fund managers who've just recently started, either on their own, putting sort of their own wealth into the markets, or even taking money from friends and family and external clients. There are some who've just had 6 months of experience, and obviously the markets have done what they have done. But what would you suggest someone to do right now, for someone who's just started taking external money?
Right. Jay, as you know, I started my own fund back in 2009 called Forefront Capital, which I then sold to Edelweiss in 2014. And I think the one thing that I learned through many of the tough years like 2011, 12, 13, when India was really in the doldrums, was to really listen to what clients are saying and what clients want. You know, uh, we are too often engrossed in our portfolios and our strategies and our stock picks. But when you're starting out on your own, you'd be better off listening to clients and what they want.
Okay, fair enough. I think that we've seen a lot of people struggle more with also the emotional quotient, saying that look, I need to question a lot of things, which is what I asked initially as well. And obviously, listening to clients should help them, navigate this much better.
Absolutely.
Thanks, Nalin, for your time.
Thank you, Jay.
I'm pretty sure our audience would love to hear more from you. Unfortunately, we are out of time. But is there something else that you would like to add to our audience?
No, and if there are further questions, you can always reach out to me on Twitter. My handle is Nalin Moniz, and I'm also available on LinkedIn and very active there as well. So please reach out, and would love to engage on anything that I spoke about. Thank you for the opportunity.
Superb. No, most welcome, Nalin. We are happy to have someone like you on the Juggernauts who brings a very different perspective. Hope everyone is safe at your place, including your parents, friends, and family. And hopefully, when things normalize, we'll definitely catch up again.
Awesome. Thank you, Jay. Thank you.
Okay, thanks, Nalin.